Now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Good morning, welcome to the show. It is 6:06 as we kick off this morning's edition of The Real Investment Show. Top news headline of the day, world's most wanted terrorist dead in a U.S. drone strike. Pretty amazing. It's the fourth time he's been pronounced dead, but he's really, really dead this time. Really, really, according to the Biden administration. So we'll see if he pops back up again. He's a rascally rabbit, that one. They like 2 years ago, it was like, oh, he died. And then now we killed him. So he's really dead now.
We're hunting terrorists.
Exactly. So anyway, lots of stuff going on this morning. This morning we're talking about when misinformation becomes fact. I thought it was very interesting. 2 days ago, a economist from the American Economic Institute, Enterprise Institute, and I mean this is a think tank of economists, and one of the economists there came out and said, yes, 2 quarters of negative GDP growth is a recession. That's what we've been using in the United States since like 1900 as a measure of when you actually have a recession. In fact, it's not just the United States that has that classification. It's also the same one that's used in France and several other European countries as well. It's kind of just the normal kind of standard. It's very similar in measurement that we talk about bear markets, right? Markets are down 20%, you're in a bear market, right? We just kind of pick these arbitrary numbers. And now, as we've talked about before here on the show, just because you're down 20%, if you're still in a bullish trend of the markets, then you're not really in a bear market. It just kind of feels that way. And that's really kind of the same thing with a recession, is that there's no real structured classification of what a recession is. And for a recession to happen, we have to have A, B, C, D, E, F, G, right? We have to have all these, kind of line items. Like LEI has to be negative, ISM has to be negative, and we put all these together, and that's a recession. Our normal classification has been roughly two negative quarters of growth, which we've had, as a recession. Now, why do I bring this up? Is because so this economist, very smart group of people, right? Way smarter than other people. And we'll get to those other people in a second. Came out and laid out this whole long kind of, information, fact-based, analysis of why the economy is probably in a recession. Now, yes. Now, very true, we have not announced we're in a recession. And we normally never do. Generally, economic growth is stronger by the time that we actually announce the recession, because it takes a while for the National Bureau of Economic Research to collect all the data, look backwards, and say, hey, we're in a recession. A good example. In December of 2007, we wrote a newsletter. And in that newsletter we said that we are about to be in, or are already in, the worst recession since the Great Depression. Now, at that particular time, economic growth was about 1.2% in the fourth quarter of 2007. So how on earth can you say we're in a recession when you have positive economic growth? Now, of course, we know what happened in 2008. We were in the worst recession since the Great Depression. That was because all the economic data said we were heading in that direction. And just because you're not there yet doesn't mean you're not getting there. The trend of the data is just as important as the data itself. Which direction is the data trending? Now, in December of 2008, a full 12 months later, after the collapse of Lehman, after the housing meltdown, the National Bureau of Economic Research came out and said, oh yeah, that recession, it started in December of 2007, a full year earlier. So by the time the announcement comes, it's going to be too late to matter, and it's not going to matter. So what was interesting about the American Economic Institute is that when they published this analysis on the recession, PolitiFact, which is Facebook's fact checker group, right? Now, this is the group that's supposed to check all the facts and say, yeah, this is misinformation or this is real information, right? The group that Facebook is depending on to distinguished between misinformation and information, came out and said that is false information. The White House said we're not in a recession, so that's the real fact. See, the problem with all these fact checkers is that they don't really check facts. They just spin out a political bias. And again, this misleads people into understanding what's really going on with the economy. Now, look, there's a very interesting chart out this morning. Survey of cities around the country shows a very sharp decline in the number of people that can actually pay their bills. Now, this also flies into the face of a lot of the economic spin we've gotten out of the White House that said individuals are flush with cash. We sent individuals $5 trillion. They've got plenty of cash and savings. The inflation isn't a problem. But yet, in 20 cities around the country, people are having a very difficult time paying bills and a very sharp decline from where they were just last year. That's because of inflation. Now, as inflation eats up consumer spending, economic growth is going to slow, and we saw this yesterday in the ISM report that came out. That's the Institute of Supply Manufacturers, came out and said that there was a very sharp drop in new orders. New orders are actually declining into recessionary territory. This means people are not ordering stuff. Not surprising, they're running out of capital. But again now, one of the things you're going to see retail spending, right? Consumer spending, that's going to remain strong for right now. Why is that? Well, because of inflation. We have 9%, almost 10% inflation. Because of those high inflation numbers, people are spending more to buy less stuff. So since we measure spending in terms of actual dollars spent, if I was spending $1 last year on a particular item, I'm spending $2 this year for that same item. I'm not buying more items, I'm just paying more for it, but that registers as a spending increase in the economic data because I'm spending more dollars. So this is going to show up in the economic data. It says, well, personal consumption is still strong, spending is still strong. I don't really understand why we're having these recession talks. Well, it's because people are spending less and the economy is going to slow because of that. And lay on top of this the fact that you've got the Fed hiking rates, tightening monetary policy. That's going to further impact consumption and spending, which is the whole goal, as we've said before, of what the Fed is doing, because as the Fed hikes interest rates, as the Fed tightens monetary policy, the whole goal of that is to make things more expensive for individuals to buy, so they slow down their spending. As they slow down their spending, you get slower economic growth. As you get slower economic growth, you have less demand. Less demand equals less inflation. It's just the laws of economics. But again, we have an election coming up, so it's not surprising you're seeing such a full court press right now about a recession. Now, here's what's interesting. Historically speaking, presidents do not survive economic recessions. The fortunate news for Joe Biden is that by the time that we get to the next election for president, we'll be out of the recession. We'll actually be back in a growth phase. So it's going to look like all the policies that whatever the government does now at this point, whatever policy they pass, if they pass this new bill to help boost green energy, the Inflation Reduction Act, which is neither a reduction of inflation and actually taxes the lower class quite dramatically, actually, because of the spending that's going to occur on the climate-friendly projects that are going to increase taxes on the lower 80% of people. No matter what they pass here, because of the time frame between now and the next election, the economy is going to improve. So they're all going to be able to point back and say, see, our policies worked. It will have nothing to do with the policies. It will be the function that we have gotten through the economic downturn, and the economy will be back on the mend, because that's how recessions work. And the Fed will be lowering interest rates by that point. We'll be back to QE, and it'll look like policies actually worked. That's the PolitiFact. Be right back after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Inflation touches every aspect of your life. No one can avoid it because we're living in an inflation nation. RIA Advisors has a 9-step inflation battle plan, and we're sharing it with you in a special summer lunch and learn, Thursday, August 4th at noon. Register now at realinvestmentadvice.com. There's no magic elixir against inflation. Our 9-step plan can help you blunt inflation's effects. Register today at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Could your job still be at risk? A new normal can still include new obstacles. A severance package can be an emotional as well as a financial decision to consider. Wouldn't it be comforting to review the options for you and your family with an objective financial partner? At RIA Advisors, we're here to help. From severance pay, tax timing decisions, to how to maximize unemployment benefits, the RIA team wants to make sure you can do what's best for your family. There's no charge for a consultation, so reach out to RIA Advisors, 855-RIA-PLAN, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. 6:17, big day for the Roberts household. Closing on the sale of our house. Woohoo! Another check mark on the to-do box. Been a busy few days here trying to get moved and settled down. So, but getting there.
Meet the neighbors?
Not yet. I live in a hippie neighborhood though. So, if you don't know Houston, if you're, not from around these parts, as we say in Texas. So I was living in the suburbs out in Katy, and that's where we'd moved out there to raise our kids, and schools are I refuse to pay for private school. It's just stupid to spend that much money for schooling. So I moved out to Katy so I could send my kids to public school in a decent area. And now that all my kids have pretty much have now graduated and gone, in fact, my son was sending me pictures yesterday from College Station. He's got his room all set up. He's pimping out, right? I mean, he stole all my used stuff in my house. I was trying to move. I was missing televisions and all kinds of stuff. And I know where they are now. Thought I'd been robbed, but no, it's my son moving out to college. And of course, my daughter's leaving for Texas Tech on the 13th of this month, 13th, 14th, something like that. So anyway, kids are all leaving. So we moved back. So our office is at basically in kind of, I guess, it's not Midtown where we are.
Where we are?
Yeah.
No, this is the Far West Energy Corridor.
Yeah, we're in the Energy Corridor. So anyway, that's where our office is. And so we moved close to this. And so we're kind of in this memorial area. So it's an old neighborhood, though. And it was built back in the 60s, 70s. And interestingly enough, I find out that my wife's cousin grew up 3 doors down from where we live now,
Wow.
right? So just totally coincidence. We had no idea, right? Just total coincidence.
Is there a plaque up or anything?
No, it's probably cops still cruising by knowing him. But anyway, this house is, so the house that we live in was built in the 1970s, and so it's a smaller, kind of older house. And all these houses were flooded during Hurricane Harvey. They had released the dam during Hurricane Harvey. Reservoirs were filling up, and they were afraid of that the dam was going to burst, and so they released the water behind the dam. And while they did, it flooded the bayou, and it completely just drowned this neighborhood. And what's amazing is there's a park right behind this neighborhood called Terry Hershey Park. And it's a beautiful park, bike trails, running trails, all kinds of stuff. And we had gone out this weekend to walk the dogs, and we're walking through the park, and the park runs behind where our neighborhood is now. And it's about 50 to 60 feet up the embankment from where the bayou is. And so as we're looking at that, we're going, it's amazing how much water came through that during Hurricane Harvey, because you had to fill up 50 to 60 feet of embankment, and then it rises probably another 30 feet to get to the neighborhood. And these houses were flooded halfway up the house. So, I mean, you're talking just a massive amount of water. So anyway, all these houses were rebuilt after Hurricane Harvey. They've all been updated and stuff. And of course, as soon as that happened, all the hippies moved in. So, and when I mean hippies, I mean millennials and Gen Zs. They're all they've all got their full face beards and dad bods, and they're,
So the hipsters.
The hipsters.
The hipsters.
The hipsters have invaded. So I'm like the old guy on the block, and the rest are hipsters. And it's a very interesting neighborhood because everybody's very vocal about their politics, but not verbally. It's how they decorate their house. And let me tell you, this is the funniest story, right? So I'd leave for work in the morning, and because I get up at 4:00 with Brent, and we're chasing chickens out of our yards and roosters, and so you drive by this one house. It's this 2-story house, and it's got these beautiful white columns out front. Well, during the day, it just looks like a normal White House, right? This White House with these big white plantation columns. Well, come about 4:00 in the morning, the lights come on, and each one of these columns are wrapped in Christmas lights, red, white, and blue. So it looks like the flag running up and down these columns. But as you drive down the street, what you'll notice is there's a bunch of houses with American flags out front. Mm-hmm. And scattered amidst them. And so if you kind of want to know the political dynamic of the neighborhood, about every third or fourth house in the neighborhood. So it's like, American flag. There's, some veterans in the neighborhood, and they've got their banners out. Mm-hmm. And then there's this one house that's tucked back, and it's got a Beto O'Rourke and an abortion rights sign in the front. There's another house at the end of the street that's got a gay pride flag out front. And so it's like everybody's marking their territory as what they are. So my wife and I have decided what we're putting out. We have a concrete statue of a military soldier.
From what era?
From
Confederate or
no.
World War II.
I'm not racist.
World War I.
Modern
day
soldier. And anyway, we call him Sarge. His nickname is Sarge, and we've had him for years, and he adorned our previous house. And so
you brought him with you.
He's 1,500 pounds. You should have seen the movers moving that one. That was freaking hysterical. They were trying to lift him and carry him. I was like, use a dolly, just roll him to the truck. No, they wanted to pick him up and move him. He's solid concrete.
Put him over by the cement pond.
Exactly. Well, he was in front of our house at our last house, and he was like the neighborhood attraction. All the kids would come by and take pictures with Sarge and stuff.
The Sentinel.
Yeah, and so he will now be migrated to the front of our house in the flower garden.
Very nice. Yes.
So that's coming. So the fight is on. Anyway, my wife and I are apparently the old people in the neighborhood. So
really,
yeah, it's all young hipsters living there, and it's gonna be very interesting to see how this works out. But it's one of those neighborhoods where everybody goes. Everybody has what they call them, Adirondack chairs. The Adirondack chairs.
Yes.
So all the houses have Adirondack chairs out front of their house, and swings. There's like my next door neighbor 2 doors down has a picnic bench in his front yard. Can't figure that one out. But apparently it's one of those neighborhoods where everybody just hangs out.
Well, as long as the Chevy's not up on blocks in the front yard,
no, that's
good,
not that. No, all the houses are very well kept.
Yeah,
everybody keeps up.
Well, my brother lives a couple of blocks from you.
Okay.
Yeah, so I know the neighborhood.
Okay, you know the neighborhood. And so anyway, this is gonna be. I think I'm gonna have lots of interesting tales about holidays to tell you.
I think you need to hold a block party and film it.
Yeah, I think there will be plenty of block parties.
Yeah.
That I'll be able to film. I don't have to host one. So anyway, this is gonna. I just have a feeling this is gonna be more than interesting than not. So we'll see what happens. Anyway, Well, we just killed almost the whole segment there.
Almost, yeah.
So this morning, futures are opening lower, and I didn't get a chance to do a market update kind of at the open, but if you take a look at kind of where the market's trading right now, and Brent's going to bring this chart up for you in just a second. He's busy making notes for himself. So, that was my subtle hint to bring up my chart.
You like that?
Yeah, I like that.
There you go.
There you go. Gotta zoom out a little bit.
I'll fix it.
Okay.
Keep talking.
Okay. But what is notable is that the market is very, very overbought here short term. And this is something that we've been talking about here for a good bit, from the standpoint that, as we take a look, the MACD signal, which is one of our more important indicators for rallies in markets, it's been a very slow advancing MACD indicator, and it's been rising now really since the kind of the year lows. And from that point, we've been kind of establishing these points of higher lows and higher bottoms, kind of a rising markets. Just recently, we talked about breaking above the 50-day moving average, breaking out of this downtrend channel that we've been in really since the beginning of the year. Now, that pickup, of course, has been very welcome, because we've been talking about just how negative sentiment has been, how offsides investors have been, and of course, this rally is now starting to pull a lot of that bearish sentiment back out of the markets. Well, one of our, all of our indicators are now back to more overbought levels and actually approaching more extreme overbought levels. And so yesterday we had bought a position in Amazon for our portfolio that, we bought it just before earnings. The stock popped like 12%. After earnings, we sold half that position yesterday, just took the profits because it's now 3 standard deviations overbought. Apple's very overbought. Microsoft's very overbought here. So likely going to take some more profits here in the next day or so. But futures are pointing a little bit lower this morning. And it won't be surprising, and I actually wrote in the newsletter this past weekend that it wouldn't be surprising if we saw some profit taking this week, because of the fact markets have run so much in such a short period of time. And earnings aren't great, by the way. Earnings aren't great. The stocks are rallying on earnings that are not as bad as expected, right? It's kind of like saying, well, the world's not on fire, but it's completely underwater, right? So, it's just, not as bad as expected earnings won't sustain a rally. You need earnings that are growing, and that is not, what the markets, are going to be running on, right? You have to have, earnings that are growing, and that's not going to be the case here as we go further into this year, because economic growth is slowing. That's going to impact earnings. Profit margins are shrinking because of inflation. That will impact earnings. Consumption is going to slow down. And again, where do revenues and sales come from? Is from what you and I spend. And so if spending is slowing down, earnings are going to slow down. So this rally is going to have a very difficult time maturing into a full-fledged bull market with the type of economic backdrop that we have. So again, point here is markets are very overbought. Probably a good time. Rethink your portfolio a bit, maybe take a little bit of profit off the table, rebalance some risk. I think you have a better opportunity to buy in the next couple of months. I'm your host, Lance Roberts. Be right back after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Inflation touches every aspect of your life. No one can avoid it because we're living in an inflation nation. RIA Advisors has a 9-step inflation battle plan, and we're sharing it with you in a special summer lunch and learn Thursday, August 4th at noon. Register now at realinvestmentadvice.com. There's no magic elixir against inflation. Our 9-step plan can help you blunt inflation's effects. Register today at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Got a PE that's not so growthy anymore.
Exactly. Growthy. It's a new term.
Growthy.
It's a new term.
word.
Growthy.
Write that down.
It's a new Bushism for Michael Leibowitz.
The Real Investment Show podcast. Same show, your schedule.
And I guess this really goes to portfolio strategery as
Growthery and strategic.
exactly.
At realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Have market gyrations caused you to lose sleep? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. If you think it's time to work with an advisor who puts your interests first, it's time for Real Investment Advice. RIAadvisors.com.
You're listening to The Real Investment Show.
So it's some interesting stuff that's going on. We've talked a little bit about the impact of policies right now that are all focused on climate change, and it's the focus on greenhouse gases, particularly CO2. And there's a belief that if we can just solve the CO2 problem, that we'll solve the climate change problem. And we're spending all this money and effort to try to solve one factor amidst a litany of other factors that go on, assuming if we can solve this one problem, it'll solve everything else. But the solutions to solving the problem are causing other things to get worse, which is always the case. And case in point right now, Germany is a good example. And my son lives in Germany, and we have a lot of conversations about what's going on over there. And of course, Germany tried to make this switch to more green energy. They started shutting down their coal plants and, backing off of nuclear, and all in favor of wind and solar. Of course, now that they've shut off the gas pipeline coming in from Russia for the most part, they're having massive trouble meeting energy demand. And it was interesting. There was a story out this morning. Dirty old coal is making a massive comeback. And we talked about, the whole fallacy of ESG investing, and that ESG investing would be all fine and dandy until other assets started performing better. And we talked about back in 1999, there was the whole movement to not invest in sin stocks, no gambling, no pornography, no alcohol, no tobacco.
And those were the best performing stocks during the dot-com crash. So all these things sound good until performance starts to show up somewhere else. Well, coal stocks are killing it right now because there's now money being invested into doing what? Building new coal plants, because we've underinvested in coal power plants and we need electricity. And the more demand we put on the grid trying to solve the CO2 problem by driving electric cars, the more you need dirty energy to fuel the electricity to help charge the cars. See, everybody forgets the link that goes on, right? We talked about before on the show, it costs, the carbon footprint to build an automobile is about 3 times as large to build an electric vehicle than it is to build an ICE vehicle, an internal combustion engine. And so it takes about 300,000 miles on a 400-mile equivalent car to break even on the carbon footprint. So again, we're not really solving the problem, and not to even mention the issues with disposal of batteries and solar products and things that are now polluting and poisoning the water systems, et cetera. There's all those other problems. But, we don't focus on the other issues that are also causing potential climate change. Like we've had a lot of solar flares, and we're not investigating and spending money to look at the impact of solar flares on the heat that we're experiencing on the planet, right? And the increase in temperatures. Another one that we're not looking at is very interesting is that the moon is actually slowly leaving the Earth's orbit. It's very slow. In about 1 billion years, the moon will actually leave the Earth's orbit. But every year, as the path of the moon gets further and further from Earth, it's lengthening our daylight by very small fractions. And so the days are actually getting longer as the moon moves further and further away from the Earth, which means you've got more sunlight hitting the Earth, and that's also increasing temperatures, right? And so there's all these other factors, right? We're focused on CO2, but there's all these other factors that potentially, I'm not saying these are all contributors to climate change, but there's all these other factors that we're not paying attention to or studying. And as we talk about rising sea levels, right? As solar flares and longer days are leading to higher temperatures and more in just longer periods of temperatures, water expands, and of course you get rising sea levels because of the expansion of water, right? It's just we live on a dynamic planet, and so the word dynamic in and of itself means that it's always changing. But we're making these decisions, right? We've got to go green and we've all got to drive electric vehicles, but then we don't look through the whole process of the impact that it causes on the environment of having to produce all that electricity. So, this is, one of the problems that, ERCOT's been talking about. ERCOT, by the way, is kind of our electrical power governance system here in Texas. And, they're talking about a potential overload on the electrical system because of the heat here in Texas. California has rolling brownouts. California's been having rolling brownouts forever because they've underinvested in their electrics and they've moved away from nuclear and everything else trying to be green. And that's awesome. No problem with that. Don't have any problem with it. But again, you're causing yourself all these other problems that are not going to go away. They're only going to get worse. And so this dramatic increase in spending that we want to do to try to fix these problems, and this is one of the, there's a lot of articles out all of a sudden. Senator Joe Manchin, of course, supported the negotiation with Chuck Schumer. He came to this agreement that he would be okay to, he would support the Inflation Reduction Act, which will not reduce inflation at all, because the money that's being spent is on things that are going to actually impact by leading to more inflation across time. But it's also going to pass through, and again, the problem always with tax is that the taxes trickle down from the wealthy to the poor. That, there's going to be no tax increases. George Bush Sr. said this back in, post-Reagan era. He said, read my lips, no new taxes. And of course, taxes just ram through the middle class because taxes always trickle down. And so this Inflation Reduction Act is going to be a fairly massive tax increase to the bottom 80%, and particularly to smaller businesses, which are the heartbeat and the backbone of the economy. So again, now you've got inflation and higher taxes potentially if they pass this bill on the very group of people that you depend on to support the majority of economic growth. So this is just really going to kind of make things worse. And this is always the case of these bills, right? You know, we passed these bills back in 2020, 2021 to give people money. It's like, oh, we're going to give people money. I wrote an article. It's on our website. And it's talking about, you know, Joe Biden said at that time is that we're going to reduce the poverty levels in the United States. And I said, yeah, you'll reduce the poverty levels for about exactly 12 months. And it did, right? All this money we gave people actually lifted people out of poverty. And there was a lot of headlines, you know, on the media saying, hey, you know, we reduced, you know, the poverty level of the United States by doing this money. Well, they're all back in poverty and worse now because of inflation. But this was the side effect of all that money that we put into the system. So, you know, the problem with government trying to solve problems is that all it does is shift the problem and generally makes the problems worse on those very people that you're trying to support. And we talked about this before, you know, right? That the government wanted to, you know, provide this money. And what we needed to do was we needed to give people more money for childcare, so that they could go back to work. They could pay for childcare. That way they could go back to work and get to work back in the economy. Well, that's great until you do the economic math, which is very simple, which is that if Brent's providing childcare services and he knows that I'm getting more money to pay for childcare services, what do you think he does to the cost of his childcare services? He raises them, right? That's why you have inflation. So childcare doesn't get cheaper because you give me more money. It actually makes childcare more expensive. And that's the impact that we've had. You know, the best thing to do if you really want to fix the economy, if you really want to get things back to normal, stop messing with the economy. The economic cycle will take care of itself. Supply and demand will balance. And prices will fall in line with that supply and demand. The more you interfere with it trying to help only makes things worse. Let me help you put out the fire by throwing gasoline on it, right? This is the attitude of government. If you just leave the fire alone, it'll burn itself out eventually. It's supply and demand. As long as there's fuel, the fire will burn. So the wood is the supply, the fire is the demand. When the supply runs out, the fire is going to die out with it. I mean, it's just the way that's going to work. And it's the same thing with the economy, is that if you let economic balances come back to normal without intervention, you'll solve your inflation problem, and you'll actually, believe it or not, wind up with stronger economic growth over time, because part of that reversion will be a debt reduction. The less debt you have, the less debt you have to service, which means you have more disposable income to spend elsewhere in the economy. So you actually wind up getting stronger economic growth. These aren't hard things to understand, but they're not popular, and they don't get you elected. Right? What gets you elected? Give me free money. That gets me elected. You know, this and that attitude goes all the way back to the turn of the century when, you know, politicians were running and promising a chicken in every pot, right? If you're going to give me a chicken during the Depression, having a chicken was the same thing as having a stimmy check. But if you promise me a chicken in my pot, I'll vote for you. We've just gone from physical delivery of chickens in pots to, you know, electronic delivery of checks to households. The problem, of course, again, is that you wind up with the payback. There is nothing that is for free in the economy. Everything has to be paid back at some point. The only question is when and how do you pay for it. Free money isn't free. You're just paying the tax on it now, called inflation. Be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Inflation touches every aspect of your life. No one can avoid it because we're living in an inflation nation. RIA Advisors has a 9-step inflation battle plan, and we're sharing it with you in a special summer lunch and learn Thursday, August 4th at noon. Register now at realinvestmentadvice.com. There's no magic elixir against inflation. Our 9-step plan can help you blunt inflation's effects. Register today at realinvestmentadvice.com. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. So, I got a question on YouTube here talking about why is the 10-year interest rate so low when inflation's going up? Is the Fed buying bonds? No. You have to understand how bond markets work. And we talked about this last year. And one of the reasons that we continue to maintain our bond positions in our portfolio and are going to be adding to them actually here very soon is because when you get inflation or the Fed's hiking rates, that doesn't affect the long end of the curve, right? When the Fed hikes rates, all they do is impact the very short end of the curve. And, you know, their Fed rate hikes run out to about the 1 year mark, right? So the 3-month Treasury, the 1 month Treasury, the 1 year Treasury, those are all impacted by movements by the Fed. The long end of the curve reflects economic demand. So everybody's like, well, you know, if inflation is X, then, you know, 10-year Treasury rates should be X. And, you know, this is where Jeff Gundlach and Bill Gross have been wrong for, you know, the last 6 years. They've been calling for higher interest rates and, you know, talking about 5 and 6% rates. And we're not ever going to get there because the economy can't support higher interest rates for very long. It impacts demand, it impacts consumption. And what drives the long end of the curve is economic supply and demand. So as the economy is beginning to slow, inflation is going to decline, and that's what the 10-year Treasury rate is already telling you. And look, it's going to bounce around. It's, you know, we're down to 2.6, I think, right now in the 10-year Treasury. It could bounce back up to 3. In fact, I'm kind of expecting it to do so we can actually add to our bond portfolio. But by the time we get through the recession, interest rates on the 10-year Treasury will be somewhere between 0 and 0.5%. And that's just a function of time and economics and when the Fed starts reversing, you know, rate hikes. And as the Fed starts cutting rates, then the 10-year Treasury will drop dramatically because when the Fed pivots, that's not, as we talked about on the show yesterday, Jim Cramer says, time to buy stocks is when the Fed pivots. No. When the Fed pivots, that means you're about to be in a recession, the real recession. And when that impact comes, you're going to have a realization that risk assets are not the place to be, and money will flow into treasuries for safety because that's where your risk-free rate is. And so this is why, first of all, bonds are already telling you that we're heading towards a recession. Bonds are already picking up the risk off trade. And that's only going to increase as we get further out. So, this has been one of the mistakes that everybody's been making. Like, oh, well, the Fed's hiking rates and then the Treasury rate has to go up. And it's like, no, it's exactly the opposite. The 10-year Treasury is a risk-off trade. It is a economic demand trade. It is a realization trade of what's actually going on in the economy. So, no, rates are going lower, not higher. A couple of things here as we get ready to wrap up. This morning we're got a lot of earnings coming out. We've had a lot of earnings out over the last couple of days, and it's been very busy. And of course, in the next week, we're going to be through about 80% of the S&P 500 earnings. So we're going to have a really good handle on really kind of where corporate earnings are, what they look like. And of course, analysts are now waking up to the realization their estimates were way too high. We're having a race of reduction right now on earnings estimates. And of course, we do that so that we can play the beat the estimate game by corporations, and they come out and announce earnings that weren't as bad as expected, right? That's how we get this game. If estimates were where they were at the beginning of June, the misses would be dramatically worse. We would have misses like we saw back in the first quarter. But analysts have been so busy dropping estimates now that companies are missing by just a smidge. And of course, now as the rest of the year goes and as we get into 2023, those longer end estimates are going to have to come down as well. So we've got a lot of reduction in earnings estimates to go yet to get to a more normal level. And that's going to take a while. Now, when we start reducing the E and the PE, right? So prices have been rising and now we're cutting the earnings. And as that does that, valuations are going to start to come back up near term. So again, this kind of trailing valuation, forward valuation, kind of measure we've been looking at, that's going to reverse here a bit because prices are rising and the E is going to start, being reduced. So on a forward basis, we're going to start to see valuations rise. But again, that's just kind of where we are. And as we kind of get through the next couple of quarters, we should kind of get to a more normalistic level of things, and then the markets can kind of start to stabilize. But we've got a lot of work to do. And a lot of this is going to come to the realization about the Federal Reserve. The Federal Reserve has made some interesting changes here from the standpoint that the announcement last week saying that they're going to go by meeting basis in terms of interest rate policy, and they're not going to give out forward guidance, has kind of left the markets adrift at the moment. Now, the markets are taking this as bullish. It's like, I see the Fed's getting ready to pivot, and that's why they're taking this stance. But there's really no reason for them to pivot. You still have very strong rates of inflation. That's going to remain the way the rest of this year unless we get into a fairly sharp contraction and start getting negative inflation over the next few months, and don't see that happening just yet because housing prices run a big lag. That's about 42% of CPI. So that's going to be a while before we start seeing, a real impact to inflationary pressures. That won't be until next year when we get into the much bigger month-over-month changes that we've been seeing this year. That's when you'll see the sharp drop in inflation, but that won't be this year. So as a function of that, there's no reason for the Fed to stop hiking rates near term, and they're going to have to keep hiking rates until they start seeing a material impact to the rate of inflationary pressures, or you start seeing a very sharp increase in unemployment. And we're not seeing that just yet. Right now we have inflation and unemployment remains low. We're still cranking out, 400,000 jobs a month. It all sounds great. Now, of course, Amazon announced yesterday they're laying off 100,000 employees, but that's a drop in the bucket. We'll see over the course of the next, few months as we get data, as incoming data comes in, we'll see how things start to level off. But right now, economic data is declining. The Atlanta Fed GDP, which is the real-time tracker of GDP on the 1st of August, sorry, on the 31st of August, they put out their Q3 estimate, which was 2.1%. One report yesterday from the ISM dropped that 2.1% estimated growth for Q3 to 1.3%. I suspect by the time we get to announcing quarter three, and by the way, that's what happened with quarter two's estimate. Quarter two estimate started out over 2%. They kind of take the average run rate, that's their starting point. And then they start subtracting from that as economic data comes in. And so they always start out at about 2%. Second quarter, we were at 2%, wound up at a negative 0.2 or 4, whatever it was. Same thing will happen here. We'll start out at 2.1%. We'll wind up at somewhere close to 0 by the end of the quarter. Now, I wouldn't be surprised if we saw a little bit stronger economic growth in the third quarter, right? And of course, immediately what everybody will say is like, oh, see, we're not in a recession. Well, we're not in a recession just yet because the National Bureau of Economic Research hasn't announced it. But we're in a very strange phase of the economy right now. And while we have 2 negative quarters of GDP growth currently, I wouldn't be surprised to see third and fourth quarter be a little bit more positive growth. And then the impact of Fed rate, because it takes about 9 months for Fed rate hikes to set into the economy. So you have this little negative 2 quarters of GDP growth. You come out, have a couple of quarters of positive GDP growth, and then the impact of very aggressive Fed rate hikes hit the economy in 2023, and you get a downturn into your recession next year, which I think is probably the more realistic scenario. So there'll be a moment in time here where the media is going to say, see, that wasn't really a recession, and which is exactly what we need to see, right? I told you earlier this year, too many people were calling for a recession for us to have a recession. Everyone's like, oh, we're in a recession. No, it's too early. And there's too many people calling for it. You don't get recessions when everybody's calling for a recession. So again, you come out of the recession technically, only to wind right back up into it as the impact of monetary policy tightening really takes hold. In fact, I'm going to write an article on this. I was thinking about a topic today anyway, so I'll work on that one. Anyway, just keep an eye on this. I think it's going to be a very interesting year. It's been a tough challenge in terms of investing this year. We'll see. This morning, futures are pointing lower. Dow's down about 172 points. West Texas Intermediate crude is ticking up here just a little bit. It's been under a lot of pressure for the last couple of days. Oil prices have been coming down. S&P futures are down 25 this morning, and NASDAQ futures are down pretty sharply, and that's going to be, kind of the status quo of the day, I suspect. Again, we've had a very sharp rally here. Markets are overbought. A bit of a pullback here would not be surprising. The key here is for the market to pull back to the 50-day moving average, not violate it, hold on to it, work off this overbought condition, and then rally again. That may be a tall order for that to happen. But we'll keep a watch on it. We're likely going to take some profits here out of a couple of our recent trades and just kind of reduce some risk, raise some cash temporarily until we kind of figure out where we are next. I'm Real Lance Roberts. That wraps up the show for the day. Sorry for all the rants this morning. I had too much coffee. Not really, but I woke up on the wrong side of the bed cranky this morning, so can't yell at the dog and kick the wife or however that goes. Can't do that, so I'll just bring it here to you every day. Anyway, get by the website, Real Investment Advice. Latest blog post is out this morning. It's on the website right now, so make sure and get that. Also, make sure you subscribe to our newsletter, our daily market commentary, and our YouTube channel. It's all there for you. Simple Advisor, our digital full research and digital investment platform, that's up and running for you as well. Simpleadvisor.com. That is simpleadvisor.com. Check it out, 30 days free. See you back here tomorrow. Have a great day.